So as of today, April 2026, Rivian is sitting right at $16.92.
Yeah, down slightly today.
Right, down about 1.8%. And look, if you are checking the same market data that we are, you are probably feeling some serious whiplash right now.
Oh, without a doubt.
Because on one hand, the charts are showing this steady technical recovery. And you've got some really high-profile analysts literally screaming that the stock is massively undervalued.
But then you look at the algorithmic tools.
Exactly. You have these algos flashing these stark sell signals. And, I mean, the company is burning cash at a rate that would just terrify a small nation.
It really is wild.
So the high-stakes question we really need to answer for you today is this. Is Rivian like the ultimate EV buying opportunity of the decade? Or is this just a falling trend value trap that is, perfectly positioned to crush retail traders?
I mean, it is the defining debate in the EV sector right now, hands down.
Yeah.
The tension between Rivian's improving internal fundamentals and just the complete chaos of the external price action. It's extreme. You have a company that is fundamentally maturing, but the market is just treating it like a ticking time bomb.
And that's exactly why, in today's deep dive, we are synthesizing all of these moving parts. We're tearing into Rivian's 2025 year-end financials, the real-time technical analysis, the underlying order flow, and those massive fundamental catalysts on the horizon.
Right, specifically that make-or-break launch of the R2 platform.
Exactly, because you simply cannot look at any of these pieces in isolation.
No, you can't. I mean, the technical charts just don't make any sense unless you understand the balance sheet. And then that balance sheet means absolutely nothing without the context of their upcoming product roadmap and, the macro environment.
Yeah, 100%. Now, real quick, before we jump into the actual unit economics of these vehicles, we just need to establish right up front that what we're doing here is a natural human discussion. We're just analyzing market data.
Right. This is strictly not financial advice.
It's exactly not financial advice at all. We are just breaking down the mechanics of the market. We are not telling you how to manage your portfolio. And hey, if you're getting value out of this deep dive, please take a second to like the video, subscribe to our YouTube channel, and leave a comment with your feedback below. We actively read them, and we really want to know where you stand on this whole debate.
Yeah, we are just here to help you weigh the probabilities and understand the underlying forces driving this specific stock. How you actually trade it is, entirely up to you.
Okay, let's unpack this.
Yeah.
Because before we can even begin to debate whether a $16.92 price tag is a huge discount or a massive trap, we have to look under the hood at the financial reality.
Right, the fundamentals.
Yeah. I mean, the core question for literally any automaker is super simple.
Yeah.
Are they actually making money on the physical cars rolling off the assembly line?
And that takes us directly into their 2025 full-year income statement, which honestly, it marks a historic inflection point for them.
It really does.
Yeah, because for the full year, Rivian posted $5.39 billion in revenue.
Which is an 8% year-over-year increase, right?
Exactly. But what's fascinating here is how they actually achieved that growth. It wasn't just, brute forcing more of those R1 luxury trucks onto the road.
Right.
In fact, their R1 deliveries were actually slightly lower. The growth was heavily driven by software, services, and then the scaling of those commercial delivery vans.
But the absolute headline grabber, like the metric that the bulls are just parading around as ultimate vindication, is the gross profit.
Yes. For the first time in the company's entire history, Rivian achieved a full-year gross profit. They brought in $144 million in 2025.
Which, I mean, that sounds kind of modest until you look at the historical context.
Right. It is a staggering turnaround. Because if you look back at 2024, Rivian reported a gross loss of $1.2 billion. So to swing from losing over $1 billion just on the cost of goods sold to actually being in the black by $144 million, I mean, that is monumental.
It totally proves that their unit economics can actually work.
Exactly. And they achieved this through just brutal supply chain renegotiations, shifting to those cheaper lithium iron phosphate, the LFP battery packs.
Oh, right, the LFP packs.
Yeah, and completely redesigning their internal network architecture to strip out thousands of feet of heavy copper wiring, which obviously reduced both material costs and factory labor time.
And look, that is a massive operational victory. But I do have to push back here for a second because we cannot let that $144 million gross profit blind us to the rest of the income statement.
Fair enough.
To use an analogy, it's like a restaurant that finally makes a $2 profit on every single burger they sell, right? But their rent and their marketing are still costing them millions a
Think
month.
the overhead.
Exactly. Because when you look at the bottom line, the reality is incredibly harsh. Rivian still reported a massive net loss of $3.65 billion for the year.
Yeah, which translates to $3.07 per share.
Right. And their free cash flow, a negative $2.5 billion.
Which basically means they are burning through cash at just a phenomenal rate simply to maintain their infrastructure, pay their engineers, and, prepare for the next massive phase of manufacturing.
Right. And if we pivot over to their balance sheet, they're sitting on $6.9 billion in total liquidity, with about $6.1 billion of that in pure cash and short-term equivalents.
But that debt load is heavy.
Exactly. The debt-to-equity ratio is pushing somewhere between 97.2% and 113%, just depending on how you structure those long-term liabilities from the recent filings.
Yeah, it's definitely high.
So let me challenge you on this whole runway thing. Management has openly stated they expect cash burn to intensify in 2026 as they prep for the R2. So in an era where capital just isn't cheap anymore, does that $6.59 billion actually provide a safe runway? Or are they going to hit a brick wall before the R2 ever even scales?
Well, that's the multi-billion-dollar question, right? But to understand it, I think you really have to view 2025 and 2026 through the lens of a transitional phase.
Okay, how so?
They are basically migrating from an unproven startup that's bleeding cash on, early adopter luxury trucks into a mature mass market automaker. That gross profit we talked about, that was the required proof of concept.
Right, showing they could actually do it.
Exactly. It told institutional investors, look, we know how to manufacture hardware at a positive margin. The intensifying cash burn you're talking about, that is the non-negotiable price of admission.
Right.
They had to completely shut down the Normal, Illinois plant for weeks just to retool the assembly lines for the R2. That means literally zero revenue coming in from that plant while they're still paying all the fixed costs.
So the market is being asked to weigh this proven unit economic model against the sheer terrifying cost of scaling it.
Exactly.
And that tension perfectly sets up the valuation debate. Because how are market makers actually pricing this exact contradiction? Over the last year, we've watched this stock get violently thrown around between a 52-week low of $10.85 and a high of $22.69.
Yeah, the volatility there is just a direct reflection of two very entrenched opposing ideologies in the market right now.
Right, and here's where it gets really interesting. Let's look at the undervalued argument first. Because if you pull the data from Simply Walsing, their discounted cash flow analysis suggests Rivian's intrinsic value is actually $42.16.
Which is a huge premium.
Exactly. If you buy into that specific model, the stock sitting at $16.92 today is roughly 61% undervalued. Fundamentally, it's on clearance.
But, and this is a big but, we have to look at the assumptions driving that model. A DCF valuation projects all the future cash a company will generate and then discounts it back to present value.
Right.
So that $42 price tag relies heavily on the assumption that Rivian, perfectly executes the R2 launch, captures a massive slice of the total addressable market, and smoothly transitions that gross profit into sustained free cash flow over the next decade.
And that is exactly where the bears, the overvalued camp, step in and call this a textbook value trap.
Oh, yeah, they are incredibly loud right now.
Right. They point straight at that negative $2.5 billion cash burn, and they say, hey, you're modeling perfect growth in a totally imperfect world. The bears are looking at the very real macroeconomic threat of federal EV tax credits just being eliminated.
Which would be a catastrophic threat to a DCF model's terminal value. If that $7,500 tax credit disappears, the effective price of the vehicle spikes for the end consumer.
Obviously.
And simple demand elasticity tells us that volume will drop. If volume drops, Rivian's entire scaling model takes a massive hit, and that $42 intrinsic value just evaporates overnight.
Add to that, the actual ownership data paints this deeply conflicting psychological picture, right? Like on the institutional side, the backing is massive. Amazon remains the largest shareholder, holding over 158 million shares.
Yeah, the institutional support is definitely there.
Total institutional ownership sits at a very strong 44.4%. But then you look at the insiders. CEO Robert J. Scaringe has been executing multiple sales, literally dumping hundreds of thousands of shares throughout the first quarter and into April 2026. So my question is, if the stock is supposedly undervalued at $16, why is the founder selling? Like, Are retail traders just being lured into a value trap with talks of a $42 intrinsic value while the insiders are quietly heading for the exits?
Look, it is entirely rational for retail investors to see a CEO dumping stock and treat it like a huge fire alarm. But if we connect this to the bigger picture, we really have to recognize the mechanics of insider selling.
Okay, lay it out for us.
These are almost exclusively 10b5-1 planned sales. Executives set these liquidation schedules months or even years in advance to avoid any insider trading allegations. It's often just to cover massive tax liabilities from vested options or for basic portfolio diversification.
So it's not a panic button.
Exactly. It does not automatically equal a panic signal.
Okay, I understand the mechanics of a 10b5-1 plan, but let's just be real about the optics for a second.
Sure.
Even if he planned it a year ago, the plan was structured to sell at these levels, and it feeds directly into retail anxiety.
It absolutely does, and the algorithms completely pick up on that sentiment. This is exactly why retail traders get chopped up. They focus purely on the perceived discount.
Right, they just see a low price?
Yeah, they see a stock down from its historical highs, they read an intrinsic value report of $42, and they just blindly hit the buy button without actually pricing in the macro risks, like the cash burn or the tax credit threats.
Yeah.
If those headwinds blow hard enough, it really doesn't matter what a spreadsheet says the stock is worth today.
Which basically means fundamental valuation right now is highly subjective.
Yeah.
So if the fundamentals are so contested, I think we have to strip away the opinions and just look at the cold, hard math of the tape. What is the actual price action and the order flow telling us right now?
This brings us straight to the technical analysis, which currently is showing a brutal tug of war. The long-term trend remains pretty neutral, but the short-term trend is technically bullish.
Right.
The stock has been basically carving out this steady recovery from the lows we saw back in late 2025.
Let's map out those indicators for everybody. Right now, Rivian is trading above all its key moving averages. It's sitting above the 20-day moving average at $15.40, the 50-day at $15.34, and the 200-day at $15.08.
And those moving averages are clustered suffocatingly tight around that $15 mark.
Exactly. In technical terms, the spring is coiling. Plus, you've got the 14-day relative strength index, the RSI, hovering right between 58.9 and 64.7.
Which means it's neutral to slightly overbought. It has
Right.
momentum, right? But it hasn't quite reached that exhaustion phase where the buyers are totally tapped out.
And the MACD, the moving average convergence divergence, is positive at 0.24, which just confirms that upward momentum. But here's the massive conflict I really want your take on.
Okay, shoot.
We're trading above all major moving averages. The spring is totally coiled. The MCD is positive. So why are major technical screening tools like tip ranks aggressively flagging a quote-unquote sell signal based on recent price action?
Right, it seems contradictory. But it all comes down to how algorithms trade against immediate resistance levels.
How so?
Well, you can have a stock that looks incredibly bullish on a moving average basis just because it's been climbing. But if that climb brings the price right up against a historical ceiling, a level where institutional sellers have repeatedly stepped in to short the stock or take profits, the algorithms will automatically flag a short-term sell signal.
Ah, okay.
Yeah, they are literally just calculating the probability of a rejection.
And we can see exactly where those ceilings are on the chart. Immediate resistance is sitting like a total brick wall right at $17.24.
Yep.
If it manages to smash through that, secondary resistance is waiting at $18.15. And then on the downside, there's incredibly strong support at $15.04, which lines up perfectly with that cluster of moving averages.
Right, that $15 floor.
But if that breaks, the floor completely falls out down to a deeper trendline support at $13.62.
And that gap right between the 15.04 support and the 17.24 resistance is exactly what market makers call the chop zone.
The chop zone. I love that term, but it's terrifying.
Oh, it is. This is a volatility harvesting zone, and it's exactly where retail traders just get their accounts drained.
Because they get impatient.
Exactly. They buy near the $17 resistance hoping for this massive breakout, right? But then the stock gets rejected, they panic as it starts to drop. And then they sell for a loss right at the $15 support, literally right before it bounces back up.
Wow.
So the sell signals you are seeing are really just algorithmic warnings about getting trapped at the very top of that specific micro range.
Which perfectly explains why the analyst community is completely gridlocked right now. I mean, the consensus rating is a split by neutral, We have 11 buys, 10 holds, and 5 outright sells.
Very divided.
And the average 12-month price target is sitting at $18.16, which implies a pretty measly 7% upside from where we are right now. Though, it's definitely worth noting that top-tier firms like Tigris Financial are stubbornly holding on to a massive high target of $25.
Right. And that $25 target reflects the absolute best case scenario for their upcoming product cycle. I mean, it just highlights how perfectly poised the stock is today. It is trapped right between its technical levels, acting like a pressure cooker, just waiting for a fundamental catalyst to either blast it through that $18 ceiling or send it crashing right through the $15 floor.
And those technical levels are going to break one way or another very, very soon. Which brings us to the actual real-world catalysts.
Yeah.
The events on the calendar that will dictate this breakout or breakdown. So let's build the ultimate bull versus bear roadmap for you.
Okay, in the immediate short term, and I mean literally a matter of weeks from now, everything hinges on the April 30, 2026 earnings call.
Oh, absolutely.
Yeah, the market does not care about last quarter's revenue anymore. They are just desperate for forward-looking updates on the 2026 delivery guidance.
And currently, the expectation is between 62,000 and 67,000 units, right?
Exactly. And if management steps up to that microphone and guides lower due to, supply chain hiccups or just softening consumer demand, the algorithms will instantly trigger a test of that 1362 trendline support.
But the real story, the medium to long-term outlook that forms the entire foundation of the bull case is the R2 platform.
The R2 is everything.
It is. Production is slated to begin in Q2 of 2026. This is their $45,000 SUV, because up until now, Rivian has essentially survived by selling $80,000 luxury trucks to wealthy early adopters.
Right.
The R2 is their real attempt at a mass market volume engine. They absolutely desperately need this vehicle to achieve true company-wide profitability.
And unlike so many of their EV startup peers who basically went bankrupt trying to launch a second vehicle, Rivian actually has the capital to try and pull it off.
Yes, the Volkswagen money.
Exactly. That is largely thanks to the Volkswagen joint venture. That massive $5.8 billion deal, which is centered around electrical architecture and software integration, it provides the essential capital runway. It is the bridge that ensures they literally don't run out of cash before the R2 starts generating real revenue.
So what does this all mean in the real world? To me, this whole situation feels like a movie studio that had a critically acclaimed indie hit with their first movie, right? The R1.
Yeah.
The critics loved it, the niche audience loved it, but it was incredibly expensive to make, and it didn't generate massive profit.
It's a really good way to look at it.
Thanks. So now the studio has basically bet its entire existence on the sequel, the R2. It has to be a summer blockbuster. If it doesn't sell millions of tickets, the studio goes under. But here is the massive risk I really want you to address. Capital expenditures are expected to literally double to $2 billion in 2026 just to get this production running. They face incredibly high execution risk in scaling an entirely new platform at their Illinois plant. Plus, they're fighting this brutal macro environment where Tesla is just aggressively slashing prices and Chinese OEMs are flooding the global market with cheap alternatives.
Yeah, it's a war zone out there.
So can Rivian actually scale the R2 without bleeding out that $5.8 billion Volkswagen lifeline first?
Well, if we connect this to the bigger picture, you've just perfectly outlined the razor's edge this company is walking right now. Let's look at the best case recovery scenario first.
Okay, the bull case.
Right. The R2 launches flawlessly in Q2. They hit volume production without the manufacturing hell that typically plagues new auto lines. Because of the scale, their unit margins improve dramatically. And the Volkswagen technology integration basically proves that Rivian isn't just a hardware manufacturer, but a premier software company.
Okay, that sounds ideal.
In that scenario, that $25 price target from Tigris actually looks conservative, and the $42 intrinsic value starts to look, prophetic.
Right. But what about the worst case scenario, the bear continuation?
The worst case is that the doubling of CapEx burns through their cash pile way faster than anticipated. Scaling the R2 at the Illinois plant faces, unexpected delays, which, let's be honest, is notoriously common in automotive manufacturing.
Happens all the time.
It really does. Meanwhile, the macro price wars from Tesla and the Chinese makers, combined with potential subsidy cuts, completely crush consumer demand for a $45,000 SUV. In that environment, the cash burn becomes terminal, the $15 support shatters, and the value trap just snaps shut on retail investors.
Man, it is a staggering amount of tension built into a single ticker symbol. Just to quickly recap the battlefield we've mapped out for you today. Under the hood, Rivian achieved a monumental milestone in 2025 by proving they can make a $144 million gross profit on their vehicles, driven by some truly brilliant supply chain and engineering pivots.
But they are still losing over $3.6 billion on the bottom line.
Right. And the charts show a coiled spring with short-term strength trading above key moving averages, but severely pinned under a heavy algorithmic resistance at 1724. And looming over all of this is the impending R2 launch, which is just this massive high-wire act where they have to double their capex in an absolute brutal macro environment.
The uncertainty right now is just palpable, and it is all going to crystallize very quickly. I mean, will management's tone on the April 30th earnings call validate the bulls and trigger a massive breakout toward 25? Or will it validate the bears, trigger the algorithms, and send the stock plunging back down to the 1360s?
It is going to be incredibly volatile, and it's going to happen fast.
But, before we wrap up, this raises an important question, one that really isn't showing up in the standard analyst reports, but one you absolutely need to be thinking about regarding that massive Volkswagen deal.
Well, let's hear it. I love a good curveball.
We talked about the high execution risk Rivian faces in scaling the physical R2 hardware.
Yeah.
And everyone in the market assumes the $5.8 billion Volkswagen joint venture is Rivian's ultimate lifeline. But what if it's actually a Trojan horse?
Wait, a Trojan horse?
Think about it. Volkswagen has notoriously struggled with their own software division, Cariad. Rivian's zonal software architecture is exactly what VW needs. If Rivian's physical hardware production stumbles, the R2 gets delayed and the cash burns out. Does this joint venture simply position Volkswagen to cleanly and cheaply absorb Rivian's cutting-edge software architecture while just letting the costly hardware manufacturing side go bankrupt?
Oh my...
Right. Is VW genuinely funding a partner, or are they just hedging their bets to acquire the best EV software on the market at a massive discount?
Wow. So if the hardware fails, the software survives,
Yeah.
just under a German logo. That completely changes the entire risk profile of the VW deal. I mean, that is a massive thought to leave you on. Thank you so much for joining us for this deep dive. We really hope this helped you map out the mechanisms and the battlefield for RIVN.
Yeah. Thanks for tuning in.
And remember, we really want to hear your take on all of this, so please like the video, subscribe to the YouTube channel, and leave a comment below to keep the debate going. Are you botting the dip ahead of the R2, or are you staying far, far away from the technical trap? Let us know. Until next time, keep digging deeper.